Hey team, welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are and what is causing them to move so that we can understand what to expect in the future. Today is March the 16th, 2023. It is now 3:44 p.m. Central Time. As you know, the markets have about 15 minutes before they close on the bond market and the mortgage-backed securities. We're going to take a look and see where that is in just a moment, and we're going to talk a little bit more about what is going on with the banks here, because that is really what we are following at this point. Until we get to the 21st of next week, which is Wednesday of next week, we're not going to have a whole lot of news that's going to be market moving. That is the day that the Federal Reserve is going to make an announcement as to the federal funds rate and what they're going to do with the federal funds rate, keep it the same, up by a quarter, up by half. We don't know. But man, it's interesting because all that is happening with these bank failures and how that is beginning to cause what's called contagion. So contagion is a word that you're probably hearing more and more, and it definitely makes sense. It definitely applies properly to what we potentially could experience with the banking industry. Now, contagion, basically think contagious, right? When something is contagious, it's caught by one and then caught by the other and caught by the other. And that's what we don't want to have happen in the banking industry. We don't want one bank failure to cause another bank failure to cause another bank failure and then have this snowball effect on the banking industry. So when you have a huge entity like Silicon Valley Bank, the 16th largest bank in the United States, go under, many people are affected. And we need to make sure that it doesn't affect other banks to the point that they are undercapitalized and unable to continue their operations or they fail. So that is where we are seeing the Federal Reserve and other entities stepping in to help with some of the banks that are being impacted greatly by the failure of Silicon Valley Bank and Signature Bank. So let's take a look here and see what I'm talking about. So first of all, if we go over here to what we're seeing in the news right now, there's articles about banks taking advantage of the Fed's crisis lending program, number one, and also we're hearing about large banks helping out smaller banks. So they're allowing lending, they're opening up their lending lines to smaller banks because they don't want to see these banks start to fail because it could create contagion and then end up affecting their larger banks. So in this case here, this article is talking about how the Fed rolled out Sunday a program called the Bank Term Funding Program. The Bank Term Funding Program. Now, this is going to get interesting here. This is something that people don't know a lot about. So the Bank Term Funding Program is offering loans to banks for up to a year at preferred terms. Okay, so it's like, look, if you were about to go bankrupt and you can't make your monthly payments, the Federal Reserve comes out and says, look, I understand you have $50,000 in credit card debt that you can't pay. I understand that you have a car loan that you're behind on that you can't pay. And those are all at, 8% interest rates, 20% interest rates. I understand. So what we're going to do is we're going to give you one loan that's going to consolidate all of your debt. We're going to give it to you at 1% interest, and we're going to stretch it out over 20 years. Now, that would be nice, wouldn't it? So all of a sudden you have, let's say that your payments are $2,500 a month that you're having a problem paying and is causing you to get pushed into bankruptcy. But then the Federal Reserve steps in and gives you a loan to where your monthly payments are $300 or $400 a month. And all of a sudden things turn over. Now you haven't diminished your debt. They haven't extinguished your debt, but they've restructured it. And that is what the banks do on a daily basis. Now that may sound strange, but it is true. So a lot of the times the lending that they're taking from the Federal Reserve is on 90-day terms. And it does not have the preferred terms that this new program does. So that is going to be helpful. The Fed is stepping in that way. Now here's something that we take this information and we say, how does that affect us in the mortgage and real estate industry? All right, so let's think about this. If the Federal Reserve is coming up with programs to help with liquidity, to help banks to survive because they're having trouble with their assets. So they're going to give them preferred loans. All right. So now let's take that and say, then why would you increase the federal funds rate amid all of this going on? Now, increasing the federal funds rate was almost a foregone conclusion a week ago. Now, all of a sudden, it's like, well, how can they do that? Why are they going to increase the federal funds rate, but then offer programs that are at preferred interest rates and preferred terms to help banks survive. And the federal funds rate directly affects banks. Okay, so this is what I mean by that. Let me show you what I'm talking about. If you were to look up and search federal funds rate on Google, it's going to pull up Investopedia, and it's going to tell you a little bit about what the federal funds rate is. So you can look this up. I'll put a link in the email and in the description below. So it says right here, the federal funds rate is the target rate that is set by the Federal Open Market Committee. That's the Fed. Okay, the Federal Open Market Committee. This is the rate at which commercial banks borrow and lend their excess reserve to each other. This is what is crazy and you need to understand. Overnight. Okay, overnight. Banks move money in the billions nightly. This stuff happens every night. Every 24 hours, they're swapping money here. They're saying, look, I need $100 billion to cover my expenses or my debts that I need to pay over here tomorrow. And I need another $100 billion. Oh, by the way, I got paid back $200 billion, so I'll pay off that $100 billion, and then I'll move. This stuff is happening all day long. This is how banks work. They borrow money to lend money at a higher rate of interest. And then all of a sudden, the money they borrowed is due. So they have to get it from somewhere else to pay that off. And they move money all over the place. Now, what if at any moment someone was unwilling to lend money to that bank? They would still have all these debts and they would not be able to pay it back because they usually pay it back with borrowed money. So they are just moving money all over the place. And it's amazing for you to see right there. They do it on such short terms that there's an actual basically regulated rate of interest for overnight debt from night to night. You understand how truly liquid the banking industry is. That's why they say that if there's a liquidity crisis. Liquidity crisis is when banks don't want to lend to each other at all because they say, look, hey, I normally lend you $100 billion a night or $1 billion a night, whatever these numbers are. But look, we're having some financial troubles here at home. So we're not in a position to lend any money. We need our money. We don't have any excess, as you saw, excess funds. We don't have any excess funds. So we can't lend any money to anyone. We're going to close the doors. We can't lend money. So all of a sudden, another bank that needed to borrow money from that bank, Bank A needs to borrow from Bank B, and Bank B is like, I need my money. But normally this happens every day. That is when liquidity freezes. There is no liquidity. So they've gone to 5 different banks that all those 5 banks are having a financial issue because of the contagion that's happening due to Silicon Valley Bank and Signature Bank. And all of a sudden, no one wants to lend their money overnight. And they go, well, where are we going to get money? The Fed. They go to the Fed because the Fed needs liquidity to be in the system in order for banks to continue to operate. And they've done that before, and it looks like they're doing that a little bit here again. So understand that this is a way of the Federal Reserve stepping in and providing the funding that is necessary to these banks at preferred terms for them to continue on, which creates something that is almost as important, and that's confidence. Banks need confidence. Investors need confidence for them to make the moves that they need to make. Okay, so getting back to what we were talking about when it comes to home loan interest rates, do we think that the Federal Reserve is going to increase the federal funds rate by 0.5%, 0.25%, 0%? Are they going to bring the federal funds rate down? How are they going to respond in 1 week, Wednesday of next week? How are they going to respond due to this crisis and what's going on right now? All of a sudden, as we've talked about before, we can talk about the statistics, we can talk about the charts, we can talk about the inflation reports, we can talk about things, historical reporting, but we never know what's going to come at us. We never know when all of a sudden the 16th largest bank in the United States goes, hey, I've been kind of keeping this a secret, but we're out of money. We don't have the money anymore because of the way they structured their debt. And this would happen. They structured their debt in a way that they were no longer able to service it because of the increases in the interest rates, basically globally, when the Federal Reserve started raising the federal funds rate. All right. So a lot of detail there, a lot to get into. What does that mean for home loan interest rates right now? So let's jump over here to the charts. We are currently down 22 basis points, and we're down 22 basis points because the banks are starting to feel a little bit confident. They're starting to feel more confident. So the investors are starting to say, okay, the Fed's going to step in. It's going to do its job. Well, it's going to do something to continue to have liquidity and stabilize the markets. We can stop with this massive buying of bonds, our flight to safety. It's called a flight to safety. And we can go back into the equities market, move money back into the equities market, including selling off some of the bonds that we purchased. So right now we're down 22 basis points, which is okay. Remember, we have still had a great run. And by the way, rates don't always just go like this or like this. They go up and down, but they find themselves on a move in a certain direction, a trend. Okay, so the 10-year Treasury is up 10 basis points, but we're still at 3.577. We're okay with that. Look at where we're at. We're in this area here instead of this area here. So we are happy with our increases to the mortgage-backed security. You can see that we come up again almost to our 101 number. There's something about this 101 number that we need to get through, and then we'll start to fight with this 200-day moving average. But right now, it looks like we're closing today down 25. We've got a couple minutes left in the market, and we may stay above this 50-day moving average, creating a floor of support because it is now 2 days in a row. Good news. Home loan interest rates. Now, what do you think home loan interest rates look like after all that we know, all the times that we've talked, how much we're learning, and the other factor, which is bank confidence, mortgage bank confidence, and are they going to pass on their profits or not? Okay, so let's take a look and see. We were at about 6.5% yesterday with a little bit of a credit coming back. We were talking about that the banks were holding on to profits, I felt, and here we are. Now we're at 6.625%. Flagstar, 11 Mortgage, United Wholesale. What is it going to take for us to get down to that 5.99? It's only going to take 0.939 to get to 5.99. So you see how buy downs are very effective today still. Why are buy downs effective today? By the way, to get to a 6.5% is only taking $284. Why is, as I open up the parameters here, show you the parameters of this loan program that we just looked at for compliance purposes. Why is it that we're at 6.625, a little bit to a 6.5, and only 1 point to get to a 5.99? Because the banks are not yet confident what the market is doing. So, and I say the banks, I mean the mortgage banks. Okay, so there's mortgage banks which are setting the prices for brokers, things like that, and what the consumer is going to see. But they're not yet accepting the movements that we've had in the past couple of days as going to be sticky. They think that they might go away quickly, that the rise we've had on our mortgage-backed securities chart is going to fall just as quickly. That is really going to be determined by the next couple of reports, by what the Federal Reserve does with the federal funds rate here on the 21st, and also with the personal consumption expenditures, PCE, on, I believe, the 31st of March is going to tell us. All right? So we have big news to come for us to be able to tell which direction we're going to go. But I hope that you see how fast home loan interest rates move and why. Understanding a little bit more of the fact that banks move, hundreds of millions, possibly billions of dollars every day. This stuff is going on. It is highly liquid, and things like one bank falling under just throws a wrench in the system. And we're having to work through that right now. All eyes go to the Fed. Let's make sure to like, subscribe, and share. I'll get back with you again tomorrow. Again, longer than normal reports, but as you can see, this is some historic information going on, and I want you to use this to really learn how the home loan interest rate market works. Have a good one. Let me know. Bye.